Good morning, everyone, and welcome to Money Corp's Market Pulse webinar for May. Great to have you with us all again. We're here to take a step back and look at what's been driving markets over the past few months, and more importantly, what's likely to happen as we look ahead into the remainder of this half year and into the second half of 2026. Today, we're focusing on the current state of play following recent geopolitical developments and what might be next for markets, whether that's foreign exchange markets, interest rate markets, or other asset classes. Now, on the surface, things feel pretty contained. Inflation isn't running away at this moment in time, and central banks are being cautious. Growth hasn't fallen off of a cliff, but we're definitely seeing signs of some problems emerging as far as the global economy is concerned. And those tensions that are building really revolve around the situation, not only in the Middle East, but also in domestic politics as well. So as always, we'll hope to help you give a sense of clarity over the current environment, and we'll make some predictions and give you a framework to think about the risks and opportunities for the coming months. We'll leave plenty of time for questions at the end, but do feel free to submit them as we go through. So without further ado, let's begin. As you can see from the title of the slide, it's about geopolitics paused, but risks rising, and what's next for the markets. And this really comes after a barrage of headlines that we've seen, some relating to the actions and activities in the Middle East, and some relating to the statements that are being made. And there is a disconnect there between the two. Some of the things that are being said are far more optimistic than what we're observing. So if we look through and see at what's happening at the moment, we'll look at, first and foremost, global growth and where the risks are there. Is there more downside than upside risk? I'd probably say that there is. Inflation and where we're heading, not just on the headline rates that are undoubtedly going to be affected by the energy markets, but also what's going to happen for second round inflation effects and the core inflation rates. We'll then look at interest rates and when we're likely to see hikes, if we're likely to see them at all, dependent on the economic jurisdiction. Finally, we'll look at the PMIs and geopolitics and how they might influence things before looking at our updated forecasts. So first and foremost, looking at global growth and the fact that there is more downside than upside risk. So we've had now both the IMF and the OECD's updates in terms of the economies for 2026 and 2027. So if you look at the initial column here, the left-hand column, that's for 2025, you can see that growth was, roughly speaking, fastest in the major developed economies in the US, but fastest also in the likes of China. And one interesting thing is the divergence between growth rates in the euro area. So if you look at growth in Spain versus growth in the likes of Germany and France and Italy, Spain is comfortably outperforming and is expected to continue to do so in 2026. That's the middle column, and 2027, which is the far right column. The UK figures have been disappointing. They were disappointing in 2025, albeit there was a marginal improvement in economic activity versus what had been expected in the middle of last year after the tariffs were introduced by the US. But by the time we get into 2026, growth, despite interest rate cuts that we've seen over the course of 24 and 25, aren't really helpful. It's not providing a tailwind for economic activity. Instead, there are other headwinds, and those predominantly are geopolitical risks that are creating the issues. And for other economies as well, I think there's this problem of slow growth. I'm still not one to believe that China is performing as well as being suggested by the economic numbers, or at least that the key developments in China predominantly revolve around the amount of additional fiscal expenditure that we're seeing. And that's unsustainable. You can't keep spending around about 9% of GDP trying to support your economy if it's only producing growth rates in the sort of 4.5% to 5% region. So I do think that there is a reckoning to come as far as China is concerned. But this is basically a who is performing the least bad type of question, not who's performing well over the remainder of 2026 and into 2027. And those headwinds from tariffs might re-emerge once the tariff that's been implemented by the US for 150 days from that February Supreme Court ruling wear off. So we're looking at sometime in July/August for an update on the tariff regime. And that happens to coincide with the US's review of the USMCA agreement that's due in the summer. So there are a number of problems as far as the global economy is concerned, but the vast majority of them seem to be revolving around geopolitics and also some domestic political decisions that have been taken. As I say, inflation is contained for now, so we are seeing upside risks as far as headline inflation rates, and we've seen those spikes emerging in the UK, in the US, in the Euro area, and in Canada as well. But thus far, core inflation, if anything, is more depressed. So we've seen core inflation rates in the likes of the UK and in the Euro area dropping back. Core inflation still remaining very well anchored to its 2% target rate in Canada. And as far as the US is concerned, there are some signs of an upward creep in core inflation in things like the core PCE index, which has tended to be the Fed's favored measure of inflation. But overall, if you look at consumer price inflation, which is what's measured on this chart, it's still not grown as much and not increased as much as was feared when those geopolitical risks emerged in the Middle East. Energy prices remain very volatile. So we've seen oil prices as high as almost $125 a barrel if we're looking at Brent crude in recent weeks, but also as low as below $95 a barrel within that same time horizon. So that volatility might create some problems in terms of predicting where inflation rates are going to be going over the course of the coming months. And it won't necessarily be the case that we'll see inflation rates continuing to surge higher into the summer months as developments in the Middle East continue to dominate the headlines and dominate market sentiment. But inflation is contained for now, and therefore, in terms of what central banks are thinking, I think there is room for them to continue their pause before they decide on a course of action. So interest rates, don't expect hikes just yet. If there is a central bank that's more likely to hike, it is the European Central Bank. Certainly when you look at the rhetoric that's coming out of various different ECB members, they would seem to be coalescing around a view that things are getting worse as far as the inflation and inflation expectations outlook is concerned. And consequently, I do think that interest rates are going to more likely increase there quicker than we see in the US or the UK. Equally for Canada, there's definitely some suggestion that the Canadian interest rates will be rising at some stage if the inflation uptick persists. But they still have some problems as far as the labour market is concerned, and they have other problems as far as GDP growth is concerned. Now, one element that might be very positive as far as future developments on inflation is concerned is that we've actually seen some of those currencies benefiting against the US dollar. So any imported inflation effects or impacts that we might have expected could be dulled or subdued by the higher rates of exchange that we're currently seeing as far as sterling, euro, and Canadian dollar is concerned against the US. One other thing that is worthwhile mentioning is that the way has now been paved for Kevin Warsh to take over from Jerome Powell as head of the Federal Reserve. Now, it appeared that he was going to have his nomination blocked because of the DOJ investigation into Powell and the Federal Reserve over renovation costs of Federal Reserve buildings. But now that that's been suspended or dropped, rather, I do think that clears all of the remaining hurdles for Warsh to take over. But he doesn't appear to be the puppet that perhaps some suggested he might be, as far as doing the president's bidding in lowering interest rates, and he will face off against a resistant Federal Reserve in terms of the votes that we've seen recently on Federal Reserve meetings. One final point is that Powell intends to stay on as a governor, and that will further tip the scales against Walsh if he's trying to drive through any interest rate cuts in the near future, at least over the next few meetings. So don't expect rate hikes yet. I don't think, as far as the US is concerned, that we're going to see rate cuts for the foreseeable future either, so it might be a period of stability. And I don't think any of the central banks will want to move too far away from where the Federal Reserve is. So I don't think that you'll see a series of rate hikes from the European Central Bank or the Bank of England. It's more likely you might get one and then a pause from both of the central banks in order to assess just how long-lasting the inflation effects are and whether the second round effects do materialize or not. Because set against the worsening in the inflation outlook is a worsening in the economic outlook as well. So growth slower, unemployment potentially higher in the likes of the US and the UK. So we need to be mindful of those things. As far as the purchasing managers indices are concerned for both manufacturing and services, well, they've shown some progress. Well, with the exception of the services PMI in the euro area, we're definitely seeing some improvement in the outlook as far as manufacturing is concerned. That may well be because of the additional defence spending that has been pre-committed to by a lot of NATO countries, but equally as well, the requirement to try and move away or at least pivot from hydrocarbon-based energy to more renewable energy might be supportive of faster rates of manufacturing activity than we've been used to over recent years. There has also been a rebound in car production and car sales for the euro area and the UK, and that's certainly welcome news for both of those economies that have had a higher reliance on the car industry for manufacturing output over recent months, quarters, and years. So that recovery hopefully will persist, and that will mean that the manufacturing PMIs will continue to improve. That said, services, I think, could be challenged by higher inflation. So the ability of households to go out and spend is going to be restricted because net disposable incomes will be constrained by higher energy bills and higher fuel costs. So we'll wait and see whether or not we get a further problem as far as the services PMIs that has only manifested itself in the euro area one thus far, but whether we see some downtrend in both the UK and the US services PMIs in the months to come. I do think the other thing to note is domestic politics may play a part in both the UK and the US. In the UK, much closer to home and much more quickly because of the local elections and regional elections that are due today. But in the US, I think attention will switch over to the November midterm elections and the problems that the US president might be having because he is becoming less popular, particularly around things like the cost of living crisis over in the US, but also in terms of his stance on the war in the Middle East. So domestic politics may play a bigger part in terms of constraining consumer behaviours as we go through the coming months and quarters. And I don't think that there's going to be a coherent message coming out of the US either, as far as the president is concerned. He has flip-flopped fairly regularly in terms of the messaging over the Middle East war. And that can create some problems in terms of planning for businesses and also consumers preparing to make major purchases. Geopolitics. All of the same problems exist from last month. The ceasefire looks increasingly fragile, though. I mean, we saw yesterday further breaches of that ceasefire agreement with the Israelis targeting a Hezbollah commander in Lebanon and the US attacking an Iranian tanker that was trying to breach the current blockade in the Strait of Hormuz. So there are ongoing problems. We've also seen the Iranians restart missile and drone attacks on other areas of the Middle East. And I think that the prospects of a near-term peace deal are somewhat far away. I don't think that even if the US was dealing with one entire body in Iran, and they're not, they seemingly are dealing with two factions of the Iranian government, one hardline, one who's prepared to be more progressive. But even if they were dealing with one faction, getting a deal done and getting a deal agreed to that all sides would adhere to, I don't think is possible over the coming weeks. I look forward to being proven wrong, but we've heard all of the rhetoric before. We've seen the president become very optimistic about a peace deal being struck, and then only a few hours later saying, but we're not ready for face-to-face talks just yet. So it looks to me as if this will continue to drag out for many more weeks and potentially many more months to come, with the possibility of further breaches of the ceasefire, or perhaps even a total breakdown of that ceasefire agreement. Pressures, therefore, on the global economy remain to the downside in terms of activity and to the upside as far as inflation is concerned. And let's not forget as well that energy supplies are being pressurized, and that could cause issues as far as travel and tourism for the upcoming summer months. We saw in May, for example, at the beginning of May, that airlines planned to cancel over 12,000 flights, which is around about 2 million seat capacity. That's globally, so that's a relatively small amount of flights being cancelled. But I think that we could see those seats cancellations increasing as we get to the heavier periods of flights, particularly for the holiday season. So if there is a risk, I think it's that the economic downside is yet to materialize, but it's probably coming in the coming months, particularly over June, July and August. And that could be geopolitically centered around the UK and the Euro area much more than it is around the US. One other factor, though, and one potential positive, is around the growth of renewable energies, things not only like wind and solar power, but also these small modular reactors. I think the investment going into those could continue to increase. And with SMR, I think there's a secondary demand for it in terms of powering the data centers for AI continuing to lead the way in terms of investment globally. So there's still some good news out there. There's still some positives, even with all of the geopolitical risks that I've highlighted. Now, if we turn our attention to FX, I sound like a broken record on this, so I don't apologize for it. I can't understand why people still think that sterling, with all of the headwinds that it faces, both economically and politically, is going to continue to rally. And I've been out and about speaking to clients, and clients still very optimistic, and I applaud them for their optimism about the prospects for a continued rally in sterling. But I see the UK economy as a perennial underperformer, and I see it at risk of losing ground to the likes of the euro because of the fact that interest rates are higher, and therefore that could create a blockage to incoming inward investment. For the euro, the improvement in their labour market is probably the biggest difference between it and the likes of the UK and the US. So we could see the euro holding up better against the US dollar. But I still think that geopolitical risks aside, there are downside macroeconomic risks globally that are more likely to have a damaging effect on growth in the UK and the euro area than they are on the US, which geographically is a lot further away from the current hotspots of conflict and geopolitical risk in the likes of Russia, Ukraine, and also in the Middle East. If we look at other currencies, we've seen the Bank of Japan and Ministry of Finance warning about the weakness of the Japanese yen. For those clients out there that are looking at the Japanese yen and hoping that sterling yen will continue to move higher, we saw it sell off about 5 yen in the space of a few hours only recently, towards the back end of last week. And I think the risks are still in situ, that the Bank of Japan try and get ahead of their inflation problem and raise interest rates by more than the markets are expecting, or at least more quickly than the markets are expecting. So I'd be wary of anticipating a further weakening in the Japanese yen because of the threat of intervention risks and also the threat of higher Japanese interest rates. And if we look at other currencies as well, things like the Canadian dollar, which has benefited undoubtedly from the fact that they are a net oil exporter, I think there are limitations with regard to the support the Canadian dollar is going to continue to get if the economic risks, particularly around growth and labour markets, continue to manifest themselves with weaker labour markets and weaker growth. Overall, I see significant volatility in the foreign exchange market. It's a bit like watching Leeds United. Not sure there are many people out there that are Leeds United fans, but I am. Very exciting, but I have no fingernails left. So as far as the volatility out there, as far as the problems that we see for foreign exchange markets, this period of calm is just because the uncertainties have tended to cancel themselves out. But overall, I think the risks are that we could see downside for sterling and the euro against the US dollar, but more downside for sterling than the euro. With that, I'm going to end the first phase of the presentation, and we'll go to your questions. So the first question that we have is in relation to the comment on China link between GDP and jobs. Would the effect be driven by AI replacing jobs, but pushing up GDP? I think we're still in the phase. It's undoubtedly a risk, but I think we're still in the investment phase. And I don't see how the Chinese economy somehow is benefiting from an improvement in output in GDP when the headwinds that we're seeing globally and the growth that we're seeing globally would suggest that China, unless they are markedly more competitive than they haven't been over recent years, are suddenly eating everybody else's lunch. So I don't see how China's growth rate is sustainable. Yes, the idea of AI for an improvement in productivity is something that has been persistently touted in financial markets. But as I say, we're in the investment phase at the moment, not the return phase as far as AI is concerned. So I am unconvinced that what we're seeing is anything other than an ongoing an increasing cost to the Chinese government and the Chinese economy from the AI investment. And in terms of the payoff from a productivity perspective, probably several years away from any signs of that emerging. If I'm being completely honest, I don't think the figures are an accurate representation of what is going on in China at the moment. They have a population crisis. Both their working age population and their overall population is falling. They have a problem in terms of real estate, which again appears to be almost perpetual in nature, and consumer spending is not increasing at anywhere near the pace that it was, and companies are shedding labor rather than hiring more. So China, for me, is a real quandary, one that I can't square the facts against what they're telling us in terms of economic growth, but something doesn't make sense. And I still think that the strength that we've seen in the Chinese renminbi recently is a passing phase rather than something that we expect to see more significantly as a trend over the course of the coming months and quarters. So thank you for your question. Second question, from an interest rate hikes perspective, do you mean that you are expecting hedging costs against the euro to reduce following hike? I'm assuming what you mean there is forward points. And yes, I think that you probably will see a narrowing in forward points from the fact that the euro the European Central Bank will raise rates ahead of what we see from the Bank of England and the Federal Reserve. But I would caution that if you do see a benefit as far as forward points are concerned, I'd expect the spot rates to get worse. So if you were looking at sterling euro at the moment, you might see a small benefit in terms of forward point improvement. You might see a much larger sort of 1 or 2% move in the spot rate from the fact that the European Central Bank moves more quickly in terms of raising rates than the Bank of England or the Federal Reserve. So I would caution that any improvement that we're likely to see as far as forward points are concerned is going to be more than dwarfed by an adverse movement in the spot foreign exchange rate. Now, that's if you're a euro buyer. If you're a euro seller, then I think things may improve somewhat over the course of the coming months. So the third question is, would Japanese interest rate hikes increase repatriation of yen carry trades, pushing the yen higher and putting pressure on the US dollar? Well, I certainly think that's a possibility. I mean, there are conflicting forces here because the Japanese government and the Japanese Prime Minister Takaichi has suggested that she wants to be more aggressive in terms of public spending plans. So I think there'll be conflicting forces here, but I do think if we were looking this purely on an interest rate carry perspective, then the yen will be a less attractive currency, and it might drive flows into other currencies that have rates much closer to zero, such as the Swiss franc, for example. The problem with that is that will only strengthen the Swiss franc further, and that's something that the Swiss National Bank don't want. Ultimately, the Japanese would quite like to have a stronger currency on the basis that some of the higher energy prices are being amplified by the weakness in the Japanese yen. So that they would actually welcome higher yen or a weaker dollar yen. I don't think that we're likely to see the likes of the yen materially changing unless it is obvious that we see the Japanese interest rates above where markets expected them to be at this juncture. So whilst I'm hopeful, I do think that there is some reason still to be skeptical, but I'd caveat that by saying those that expected things like sterling yen to keep going higher beyond sort of 215 and through 216, they've been disappointed on a regular basis because of the comments that we've seen from the Ministry of Finance and from the Bank of Japan warning about additional yen weakness. As far as the dollar is concerned as well, as we approach 160 yen to the dollar, I think that's when we get into the warning territory or danger signs, and the flashing amber of the potential for more verbal intervention, and of course the risk of actual intervention by the Japanese authorities. Those are sort of key trigger points, I think, for the yen against both sterling and the US dollar. We've now got a question. I've been following the Norwegian kroner in recent weeks. Can you explain why the rates against the pound are dropping so much? I mean, I think this is basically oil related. The fact, although we've got a lot of volatility in oil prices, I think Norway will undoubtedly benefit from higher revenues from their oil stream. So sterling against the Norwegian kroner, the risks are to the downside, in my opinion, albeit that's got to be factored in to some extent. The Norwegian central bank may well also be willing to raise interest rates somewhat more quickly than the Bank of England because of the improvement in their economy and the fact that they are seeing higher inflation rates, which the Norges Bank might react to with higher interest rates. So overall, I would look at this and say that there's probably a bit more downside in sterling Norwegian kroner. If anything, the Norwegian kroner has been trading too weak for a considerable period of time. So this is perhaps a reset as far as the kroner is concerned. So that's it, because we don't have any further questions. It just leaves me to thank you all for dialing in today. If you have time, and sorry, I'm just going to have to switch the slide, please scan the QR code and give us your feedback. We love to hear your feedback, good and bad. Obviously, I love to hear all the good feedback, and others like to hear the bad. Hopefully, this has been useful. We're going to run it again next month. And if there are any topics that you'd like to hear about as well, you can also contact us and let us know about what you might like to hear about from a topic perspective. So please provide feedback. If there are any questions that you have remaining that I haven't answered during the presentation or during the Q&A, you can reach out and get in touch as well. In your inbox very shortly will be the recording details, and we will share with you details of when the next webinar is going to be due. But thanks very much for dialing in. I've enjoyed it immensely, even though I can't hear you. Thanks for the questions that were submitted, and we look forward to seeing you again in the near future. It just leaves me to wish you the rest of the month, or hope that the rest of the month is very successful. Have a great rest of the week and enjoy the bank holiday when it comes in a few weeks' time. Thanks very much and goodbye.